Hey traders, we're just going to take a quick look at Euro New Zealand here. We're at a critical point at the moment with this cross-currency pair. As you can see, Euro New Zealand is at this soft level of resistance, which is, of course, a level which has only broken once in the past 5 years. Last time prices were above it convincingly was in 2012, 2011, actually. We can see here that we've got 1, 2, 3, 4. This is the fifth test. All the way back in 2015, back in August, 2 years ago, we had a breakout. It's a false breakout, as you can see here on the daily, and price quickly fell right back into this range here. Well, guess what? Price hasn't really gone anywhere else since sale. We've simply seen price kind of oscillated between these kind of two levels here, around just above 1 spot 500, and of course 1 spot 725. And what is interesting with this as well, not only are we funneled between these two levels here, where price seems kind of trapped, and that's a good thing if we are looking for a predictable way of trading this. We have also got the completion of an ABCD pattern coming into the level here. Let me explain for those of you who aren't that familiar with ABCD patterns. An ABCD pattern is basically a harmonic pattern where we are looking for symmetry between points A to B equals C to D. We don't always get it, but what we are after, of course, is a Fibonacci based extension. Okay, so if we drag a Fibonacci extension from point B down to point A, we can see that actually this level of resistance coincides with the 1.618. So let me just explain how we made up this ABCD pattern. We've got point A here, A, B, C, D, and essentially an ABCD pattern is a free wave formation. Wave 1, retracement, wave 2, wave 3. It's like as Larry Passavento would say, it's like a thunderbolt, and it's a very good way of thinking about its free wave formation. Typically at the end, when we do get the completion of our ABCD pattern, price does move downwards. And okay, of course it's not guaranteed, but of course for those of you who've been trading in the field for any length of time, the more clues we have in favour of a major movement, the better, the more kind of certainty it gives us, even though nothing in the market is guaranteed. Okay, so we've got two things on our side so far for a potential reversal for the euro versus the New Zealand dollar. Another thing as well, slightly more from a fundamental standpoint, and that's the fact that in Europe interest rates are 0, and last time I looked in New Zealand they are 1.75%. So if you think about it from a fundamental point of view, you can reasonably expect the money to be flowing to the trading bloc or the country which has the higher interest rate, i.e. New Zealand, long term. So we can say that, okay, if we're selling the euro versus the New Zealand dollar, it means that those people who are selling the euro versus the New Zealand dollar are essentially having net carry every night, okay, because they are selling the currency which has the lesser interest and going long essentially on the one of the higher interest rate, i.e. the New Zealand dollar at 1.75%. All right, one other thing as well, which I quite like about this one, is we've got bearish reversal divergence. Okay, and we can see this on the stochastic here. Let me just expand this for you. There we go. So if we compare price from these 2 points here, we've got a higher high from this point to this point, but on the stochastic, on the similar points, we've got a lower high. So let me just draw this to illustrate it for you. So on price action, we've got, okay, it's making a higher high, there we go, but for the equivalent, over the equivalent time, you've got a lower high with the stochastic. That's a sign that the momentum enjoyed by the bulls is becoming less pronounced in the market, and that's a decent warning sign that the bears are creeping in. So how are we going to trade this one? That's the burning question, huh? Well, I will tell you that reversal trades, 80% of them do fail. They are high reward, low probability, you can imagine if we saw a sell set up here on the weekly time frame or on the daily time frame, and we've got all this potential downside to take advantage of. Right to the bottom, not right to the bottom, sorry, but near enough, even to the midpoint, that's pretty good reward to risk. That would be like tentatively saying a 5 to 1, which is good enough, huh? So what would we look for in order to trade this one? Well, what we'd look for on the daily is a bearish pin bar reversal, or indeed a doji, where we'd see the tail preferably above this level of resistance and the 1.618, so that we've got an efficient entry at the break of the low. Or indeed would look for it on the weekly as well. That is something which we're going to have to take a view on Friday. We can see here that we've already got the tail forming as I produce this on Thursday evening, London time. We've got the tail forming. So if this does close in its present way, or indeed lower, one way of trading this one would simply have an entry just below the low of what would be this week, stop loss above the high, and just anticipate the fall to the downside. Safe in the knowledge that we've got a long-term position, selling the euro, going long in the New Zealand dollar with this cross pair, where we're benefiting from positive carry. Okay, so this is a reversal trade. It is the completion of an ABCD three-wave formation into a level of resistance, a soft level of resistance as well, supported by bearish reversal divergence looking at the stochastic. Okay, so that is our trade idea. If this does trigger and continue in the direction that we suspect it will, based on this analysis, we expect that 4 or 5 weeks from now, we can see the euro lower than it presently is against the New Zealand dollar. Okay, that's it. Happy trading, folks.